Hey friends, Dan Passarelli here. How are you feeling today? Hey, go ahead and hit that questions box and give me a big old oh yeah if you can hear me, and that'll let me know that you can hear me. I would like to know. Hit that questions box. All right, Mike, Daniel, David, Shane. Got a lot of the usual suspects here. Kaylin, all right, great to hear from you. All right. Well, today we're going to be talking about something near and dear to my heart. I'll tell you. Oh, fans here. Great. Something near and dear to my heart. That is cash secured puts. Now, this is called the secrets to investing with cash secured puts. I'm going to tell you something. Kusuma, nice to see you. I'm going to tell you something. Uh, it's no secret, but it's just that people don't know it. So I guess that's kind of a secret. I mean, nobody's keeping it a secret, but far too many people don't really uh, have the nuances down pat. So we're going to solve that problem for you here today. What do you say to that? That sounds pretty darn good, doesn't it? All right. Now, before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here today is generalized information. Obviously, it's not specific to your personal situation. I don't know your personal situation. I'd like to get to know you better, but we're not there yet. So, that being said, use a little common sense and apply some of the things that we talk about here today. And I think you're going to be a lot better off than you were before this presentation. All right. Hi, Julia. Allow myself to introduce myself to those of you who don't know me just yet. My name is Dan Passarelli, and I am an author of two of the top options trading books. Trading Option Greeks is the one that I'm most known for. The Market Taker's Edge is another one. Working on my third book and write lots of articles and that kind of stuff. You probably saw that I write a lot on Substack. If you noticed that on the title slide here, let's take a little peek see there. Go to markettaker.com/Substack if you like to read that sort of stuff. And I am a trader. I've been a professional trader on the floor of the Chicago Board Options Exchange, the Chicago Board of Trade. I traded, as they say, upstairs. Now I trade in a retail trading account just like you. And I am the founder and president of Market Taker Mentoring, which is the global leader in option trader education. We have students in over 50 countries. We have literally trained tens of thousands of student traders to go from that demoralized feeling of not being able to do it to that feeling of satisfaction and self-assurance and self-confidence. And that's what I hope to help you with. And I'm a trading industry collaborator. I work with all the best option trading firms, the firms that are friendly to option traders that give you the things you need, like Firstrade, for example. And I also work with a lot of the exchanges and software companies, and I'm just, a globe-trotting financial pundit or something, I guess. I don't know. And more importantly than any of that, I'm a family man, married to my wife, Kathleen, who, those of you who are market taker students, you know Kathleen. She runs operations here. And my two adult children and my two little tiny dogs, a Yorkie and a Morkie. Just took them out for a walk this morning. Well, my old one, she's getting kind of old. She can't walk the whole time, so we have a stroller for her. Yes, I'm that guy. I know, but you got to do it. You got to do it. And finally, I do other things for fun besides trading. I'm a runner, foodie, traveler, and a music person. Now, it is my goal to help you with your investing and your trading when it comes to using options. And so I have a podcast that is rated globally in the top 5% of all podcasts, believe it or not. And that is called the Wealth Building with Options podcast. It teaches you specifically how to invest with options. So mastering covered calls and cash secured puts. It's great for wheel investors of all experience levels. Talk about adjustments, mindset, strike selection, analysis, and so much more. There's a new episode weekly. We just dropped an episode this week. And so if you go to Spotify or Apple Podcasts or whatever your favorite podcast platform is, take a look and you'll get this week's most recent episode. Just dropped like an hour or two ago. And best part of it, it's free. I don't even run commercials on it. It is all pure education. And if you're not sure how to get to it, maybe you have never listened to a podcast. If you haven't, gosh, you should try it sometime. It's really great. It's like somebody just feeding information into your brain. And I think it's sometimes kind of entertaining too. I tell some stories. I have some guests. So go to markettaker.com/applepod or markettaker.com/spotifypod, or just search for the darn thing online. All right, let's talk cash secured puts here, friends, shall we? How can you access the podcast service? Here, Yvette, I'm going to type my answer in there. Just go to markettaker.com/Spotify, or maybe Apple. I don't know. It doesn't matter. Spotify pod. Here, I'll put them both in there. Apple pod. So I just replied to Yvette. And I think everybody can see that response. So all you need to do is click on, you're welcome, Yvette, is click on one of those links that I sent you, or copy and paste it into your browser. You can multitask, do it now, but stick with today's seminar here because I got some good stuff to say. But you can pull it up and then listen to it later. I'll tell you what, as far as podcasts, I listen to a lot of podcasts. I'm a nerd like that, you know? So what I do is I always listen to it on my phone. Personally, I used to listen to it on Apple Podcasts. Now I listen to it on Spotify. Doesn't matter. And I listen to it while I'm driving. I listen to it while I'm running. It's, gardening. It's great for multitasking. Try it out. Try it out. Over 50% of Americans have listened to a podcast within the last year. Do you believe that? I have another good statistic for you. 76.3% of all statistics are made up. It's true. It's true. All right. So cash secured puts is selling puts with a plan. How many folks here have ever sold a cash secured put? Just say me, or say not me. I'm taking a survey. Hit that questions box right now. How many folks here, give me a me or a not me, How many folks here have sold a cash secured put at one point in their life? Mike did. Yvette did. Shane has not. Kaylin has. Anonymous secret agent man has. Anybody else? Anybody else? Hell yeah, says well, I guess one's 007, this is 006 anonymous attendee. Hell yeah, hell yeah. All right. Good, good, good. Okay, got me. All right, good, good, good. So a lot of you have. Now, for those of you who have, and we're going to break this down. If this is something you're not familiar with, I'm getting just a smidge ahead here, but when you sell a cash secured put, you can get assigned. Now, how many of you have ever sold a kit? Now, this is a litmus test. No, it's not a litmus test. It's a lie detector test. Okay? This is a lie detector test. I'm going to see who's being honest here. All right? So, I don't know if you can if you can trust yourself here. But how many of you who have sold cash secured puts have ever sold a cash secured put? Maybe the stock was at, X and you sell it a little bit lower, 5% less than X. And you say, oh, yeah, I don't care if I get assigned. I would love to buy the stock there. And then the stock goes down, you get assigned, and you get all pissed off. How many people have never done that because you're always happy getting assigned? And how many people have done that? Say never if you've never done that. Say done it if you have done that. All right, hit that questions box. Okay, we're gonna see who's being honest. Okay, hold on a second. Yvette says never. Yvette says, oh, Yvette, that is our lie detector alarm. Oh my gosh, I can't believe it. What? How did that lie detector alarm go off? I don't know. Really, Yvette? Either you are, either the lie detector caught your butt or you have a lot of good discipline and you're in control of your trading. Could be that one. Sometimes the lie detector's wrong. Sometimes it's wrong. But, 006 has done that. Often assigned on crappy stocks that I didn't want, but the good stocks don't get assigned. Yeah, isn't that how it goes, though? Isn't that how it goes? It's happened to you. Yeah, I know. Only assigned once and anticipated wheel strategy. Okay, good. So Mike and maybe Yvette, right? So I'm going to give Yvette the benefit of the doubt. Yvette would never lie to, well, it's not to me, it's to yourself. That's the thing we've got to be careful of when it comes to cash secured puts. And that's why I'm kind of talking about this here. It had dropped lower than the break even before. Yeah. All right. So this is a good discussion. It's selling puts with a plan. So we're going to hold cash in an account to potentially finance the purchase of the stock if assigned. Excuse me. Selling cash secured puts is an investor oriented strategy. Now, I got to tell you one more story. There was a guy who, this is probably a decade ago. He's one of the nicest guys that I ever met in this business. And he was one of my students. Is no longer with us. Really great guy. And he came to me and he knew that he had sort of an illness, and he said, listen, Dan, I don't know how much longer I'll be around, but I want to make sure that my family's taken care of. So I am learning as well as teaching my wife and kids to sell cash secured puts and covered calls, but mostly cash secured puts. And I want you to help with that. And I told him at the time, I don't know, I think that's kind of risky. I said this. I think that's kind of risky. I think maybe we should look into maybe selling put spreads or something else that doesn't have such leveraged risk. And we kind of went back and forth for a long time. And finally, they say when you teach, you learn. And finally, I came around and really had kind of a series of epiphanies on cash secured puts. And I see the light. And these are actually very low risk strategies when you really deeply understand them and you have the right frame of mind going into it. So let's talk about that. This is a way to generate income on low volatility stocks or ETFs. And a way to potentially buy a stock at a lower price than the current market price. And be capitalized enough to do so. Okay, so here's the risk reward scenario. You have limited profit potential and all of the downside risk of owning a stock. Wait a minute. This sounds terrible. You can only make a limited amount, but if the stock crashes and goes to zero, you lose a bunch of money? This sounds like a terrible risk reward. But stay with me. Let's talk about exactly how this works. Let's say that you're looking at a stock and you look at the November, maybe the stock's trading at, I don't know, 65 bucks, 63 bucks, whatever, 63 bucks. And you look at the November 60 puts and you could sell it at 275. You know, maybe this is like a 1 month, 2 month, probably 2 month put. Okay. So if I sell this put, the most if the stock stays above 60, remember we're starting out, it's at like 63 or something. If it stays above 60 between now and at expiration, if it stays between 60 between now and expiration, if it's above 60, the option expires and the 275 is our maximum profit. We get to keep that. Move on to the next trade. If the stock falls and it falls below 60 and is below 60 at expiration and we do nothing, we will get assigned on that put and we'll buy 100 shares for every one put we've sold. We'll buy 100 shares at $60 a share. Now, for those of you who are not familiar with cash secured puts, this discussion that we're going to have here is very telling. And it relates to some of the things that we talked about in our last little set of stories here. If the stock's at 63 and you say, well, I would buy the stock if it falls below 60. Yes, it'll be $3 cheaper there. Sure, I'll buy it. But, you know, the stock can fall to, 55, 50, 40, 30, 20, 10. If it's trading down here, you get a very leveraged loss, but a small profit. Our break even would be 57.25. So wait a minute. I thought I was buying the stock at 60. If it falls below 60, I'm going to lose, right? Yes. But you still have the 275 that you collected from selling the put. So you're effectively buying the stock at 57.25. That is your break even, or you could consider it to be the effective purchase price that you're actually paying for the stock. So let's talk about that. So now you're not buying at $3 lower, you're buying at $5.75 lower, which is about 9 point something percent lower. And I know this is a hypothetical example, but we're going to go through some real examples in just a minute. So at first blush, you look at this and you say, this is a terrible trade. I can only make 275, but I could lose 10, 20, 30, $40. Terrible risk reward. And framing it that way, yes. But there are several things to consider. One, let's look at it from an options perspective. If you think about stock price distribution, stock prices are thought to occur in a log normal fashion. So that means, or at least stock profitability. So that means if the stock starts out at 63, a little more than 50% of the time, it's going to be above 63. A little less than 50% of the time, it's going to be below 63. And a lot of that time, it'll be between 60 and 63. And a lot of that time, it'll be between 57.25 and 63. So most of the time, you're going to win. But you might say, but still, Dan, the risk reward is just not with it. Even if I have a better chance of winning, it's just too big of a risk. Okay. Let me ask you another question. Have you ever bought a stock before? Yes, probably, right, of course. Well, if you would like to buy this stock at 57.25, this is a great way to do it. You could put in a limit order, but if you don't get filled on your limit order, well, the limit order just expires. But here, if you don't get filled on your limit order, you get paid. You're getting paid about 4%, 4 point something percent over like a 2-month period or whatever it is. Annualize that, and that's, if it is 2 months, I'm just kind of making this example up, but that would be like 48% a year. Which, because most of the time you're not going to get assigned, you're going to keep it. You can look at that as what I call the cumulative cost discount. I make 275 this time, I make 260 next time, I make 280 next time, I make 203, 205 next time. Now my break even is not 57.25, it's more like 50. The trade just keeps getting better the more and more times I do this. And it doesn't have to be all in the same stock either. Further, you say, yeah, Dan, but it's a leveraged loss. I'm just putting up a small amount of capital and I can lose more than I put up in margin. Well, that's true. But if you do it cash secured, you're actually putting up $6,000 to secure the purchase of the stock. So it's kind of like, as soon as you enter the trade, because you're putting up 6,000, it's almost like you bought the stock then, but you get this extra benefit of this option premium. that you get win, lose, or draw. So when you think about it in terms of timing, sure, you don't officially take control of the stock unless and until you're assigned. But for all intents and purposes, you paid for it in advance because that part of the money in your account, $6,000 in this case, gets set aside and you can't touch it because you're securing the future purchase of this stock. They call it a cash secured put, which if I were king, I wouldn't call it that. To me, that's not quite descriptive. It's more like a cash secured future stock purchase that results from put assignment. That's way too long of a name, so maybe that's why they just say cash secured put. You kind of get all the important words in there, but it's not super descriptive. Future assignment is secured by cash. Future assignment is secured by cash. Okay, so this is a hypothetical example. Let's get a little bit more real here. So this is an example that someone could have done, just a couple of weeks ago, I guess. JP Morgan Chase and Company. You believe this company's still around? When was JP Morgan walking the earth? He was born in like the mid 1800s or something. There's still a company by that name. How about that? What do you know? All right. They must be doing something right. I guess that's controlling the money. So look, first, there was somebody, geez, I forgot who it was, who said, oh, I get assigned on all the lousy stocks, but not the ones that I want to buy. That is another motivation, is just to keep the money and hope you don't get assigned. And there's nothing wrong with that. That is definitely a bona fide motivation that has merit. And so maybe someone looks at this and they say, you know what? There's pretty good short-term support established here at 282.5. I don't think JP Morgan is going to fall below 282.5. So what somebody could consider doing is selling the 9-day 282.5 puts. You collect $1 for it. That's what the bid is. And, because it's short-term support, we'd want to keep this a short-term trade, 9 days, high theta trade to boot, right? And here, as long as JP Morgan doesn't break support, the trade wins and you get to keep $1. So you end up with something like this. Now remember, wait, where was JP Morgan? Let's go back a second here. Hold on a second. It was at, 291.65. So about $9 higher, a little over $9 higher. So it's like up here, right? More than a 50% chance of it going higher and winning. A little less than 50% of a chance of it going down, and some of that time it's going to be a winner. If it has to go down about $9, actually it's more than $9 though, right? 291.65 is $9.15, but our effective break even is 281.50, so that's actually more than $10. So that's like a little over 3% or something, close to 4% maybe. Let's just do the math here, right? 1 divided by 1065, if I got that math right. Wait, 9 per, oh, no. 1 divided by, oh, no. 1065 divided by 291.65. Yeah, 3.7%. So over 9 days, it's got to not drop 3.7%, which is not a huge move, but A, it's only 9 days, and B, there is support established there. There's not a trade that you would just do indiscriminately. You would have an opinion that at least the banking sector is not going to fall below, um, fall much. Kalen says, can you quickly cover what the bid ask is doing as the stop drops? Like the ask is increasing and the bid is decreasing. Oh, yeah, sure, of course. And so, okay, so that's important. Yeah, so that's interesting. Yeah, let's take a little look-see at that. So with the stock at 291.65, these puts are $1 bid at $1.03. Puts have a negative delta, right? Which means as the stock drops, put values go up. But the bid or the ask aren't values. The bid and the ask are prices. So and the value is like between the bid and the ask. Like if you were to look at a market maker's theoretical value, they run theoretical values and then they set their bid a little bit below it and their ask a little bit above it. So the value is always between the two. So if the stock goes down, the value of the put goes up, which means the bid and the ask both go up. Now, if it just goes down, nice and steadily, we'll probably still stay about 3 cents wide. Just about all the options on the put side here that are out of the money are 3 cents. All of them are 3 cents wide. So if it's a nice orderly decline in price, they'll probably stay about 3 cents wide. Bid will go up, the offer will go up, but they'll stay 3 cents apart. If it's a violent move to the downside, then the bid-ask spread will widen, but they'll still both go up by the amount of the delta. So, but as time passes, they also lose value as a result of theta. And that's kind of really what this chart shows is after all the theta is gone, which is at expiration, and the delta and the vega and all the Greeks are said and done because it's the judgment day. Well, either the put expires and you get to keep the buck, or the put's in the money and you buy the stock at a break even or effective purchase price of $281.50. So, there's a couple of things going on here. One, if your objective is to skate, that's what most professional traders call trying to not get assigned, skate. If your objective is to skate, hold on a second. I had to take a screenshot because I'm trying to figure out how to prevent this dumb little message from popping up there, and I can't figure it out. I spent like an hour asking ChatGPT and Googling, and I can't figure out. Why does it pop up? I've turned everything off that I need to turn off. Don't give me any messages. Don't give me messages. So anyway, if my objective is to skate, I just think, hey, there's support there. We're not going to fall below there. Then, I'm going to want to be careful. I'm going to want to manage this. If my objective is to trade into the stock, to buy the stock, then, well, I'm thrilled if I get assigned. Well, but Dan, what if it's at 275? Then you're not thrilled. Why not? For all intents and purposes, I bought the stock at the very moment I sold the put because I had cash set aside to buy it at an effective price of 281.50. So I basically already bought the stock. Yeah, but it's lower than where you quote unquote bought it, the break even price. Have you ever bought a stock and the stock went down below the price you bought it? Has that ever happened to you? Probably never, right? Of course, it happens on, well, because of the bid ask spread, it happens on more than half of anyone's trades. I mean, if you look at it closely, at some point, I mean, probably 90% of your stocks that you bought at some point during the life of it, it'll be lower than the price you bought it. This is not a trade. This is an investment. I mean, technically it's trade, but it is for investors. It is for investing. With a trade, if I'm down on it, crap, I got to close it, take my loss to cut my losses short. If it's an investment, I'm in this for the long haul. I'm not buying this stock with I'm not selling a 9-day put so that I can be in the stock for one day because I think it's going to go up. That would be ridiculous. I'm selling a 9-day put if I want to buy the stock because I want to buy the stock for buy and hold for the long term, like, 3 months, 6 months, a year, 10 years. So I don't really care if the stock is down a little bit. Now, don't get me wrong. If you're doing this on some like very volatile, crazy stock, it could be down, 50%. And, that's just a kick in the pants. But first of all, I usually don't like doing cash cured puts on very volatile stocks. Sometimes I do. But, that's just a very speculative trade to begin with. You should know what you're getting into. And the premium is going to be so much bigger on very volatile stocks that for the times you don't get assigned, it's just so much, you just get paid so much. It's just so much better. Kalen says, so if I want to skate, I want to watch the ask and make sure it doesn't exceed $1. Well, no, because on your put, I mean, at some point on your put, you sold it at $1, it's going to be over $1. And because you're selling the bid, I mean, the ask is going to be over the dollar at the moment you make the trade. So for me, the way I look at it is instead of looking at the price of the option to manage losers when your objective is to skate, instead I look at the strike price. And if the stock goes below the strike price, I'll close it or roll it or adjust it. I don't look at the option premium. Now, what that means is sometimes I could sell this put at $1, stock goes down, and I have to buy the put back at $3, losing, $2. I stand to make $1 and I lost $2. Well, that's fine. If there's more support below, I might roll it down to maybe the 275 strike. Maybe I can collect $2 there. And then if it stays above the 275 strike, then I've collected $1 the first time, $2 the second time, that's $3. And I paid out $3 when I bought this one back, so I break even. So that's why don't look at the option premium. Look at the strike price for managing your losers. Make sense? Especially because every day that passes, like even if it does get up to like $3 and you're not below the strike price, the next day, if it doesn't go down anymore, it's going to be worth less because of theta. I've got at least one cash secured put in my account in that scenario right now. I was just looking at it this morning. I didn't get through all of my stocks yet, but then I can think of two that they're I've had them for a long time, and because of theta, they're trading less than I sold them for. Yeah, and yeah, like a very volatile stock like Nvidia is one that I mean, I actually have done cash secured puts on Nvidia, but let's take a look at that one. So here's Nvidia stock. Just look at a year. So there is support. I mean, there's kind of support at about 225. I mean, there's really support at about 215. And there's always support at par levels, so 200. So if there is really support at 215, $10 lower, which is, I mean, that's only about 5% lower. I wonder if I mean, the 200 strike makes me a lot more comfortable. I would say, well, let's look at the options. Obviously, the 3-day, we're going to want to go out. Let's look at least 17 days out. Hold on a second. Wait a second. Oh, that was Apple. Oh, no wonder. I didn't think Nvidia was above 200. Yeah. Thanks, Mike. Sorry. Okay. This looks a little more correct. So we have support at about 170. And this is where you take out your darn calculator. 170 is like 1150 lower. So 1150 divided by 181.6. That's 6% lower. If we were to use 170 as support, we'd want to keep this pretty short. I always do these live on Tuesdays. So today is a Tuesday. So we'd have until Friday. So that's 3.5 days. As long as it wouldn't fall more than 6% in 3.5 days. Not to mention, there is support at that level, which will help keep it higher. That could be a strike price worth selling. Whoops. I always forget I got to move this. So then I'll go to options. I could sell the 3-day 170 puts at $1.85. Now, those of you who show up to these Firstrade webinars that I do once a week, first of all, thank you. I appreciate your loyalty. Second of all, you know that I am price sensitive when it comes to option prices. If I'm going to make this trade, definitely I want to use support as an indication of what strike to sell 170, but I can sell these at 185. How do I know I'm getting enough premium for this trade? Because sure, I like selling the 170 strike. If I could sell those at $5, great. If I could sell those at 25 cents, I don't know if that's so great. But what about in between those two extremes? How do I know that I would like to sell those? How do I know that it's a good risk reward? I am feeling generous today. This is something that I talk about in the podcast and write about on Substack. This is some secret sauce here, guys and gals. How much money would I have to put up? Okay, I'm going to do a quiz here. Whoever guesses first is going to get a prize. How about that? Look at that. Whoever guesses this first is going to get a prize. If I sell the NVIDIA 170 puts, cash secured put, how much do I have to put up in margin? Go. Bam, Justin. Goal. Dun, 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 dun. Justin, send me your email and I'll get you I'll get you what you need. Just type your email in here. Can you do it privately? If you can't do it privately, I forget if these are private on your side or not. You can just email me, dan@markettaker.com, and send me your email, dan@markettaker, 2t's.com. Nice job. So $17,000 minus the premium of 185 is how much has to be put up in margin, because that's what price you'd be. Kaylin's giving you some love here. Yes. Darn it. Good job, Justin. So it's basically what you have to pay for the stock. You're basically paying for the stock in advance is the best way to think about it. So, so if I'm selling these at 185, 1.85 divided by 170, 170, or we could say 185 divided by 17,000, doesn't matter. It would make 1% on the cash we put up. And that's over a 3-day period. How do you feel about making 1% in 3 days? If you say, I'm not too excited, you don't know what you're talking about. Or at least you should reframe your thinking, because you should be very excited about making 1% in 3 days. It's not really reasonable to annualize this return, because if I did a trade like this every 3 days, some of them are going to be lemons. So in the long run, you're not going to make 1% on every trade. So you can't really annualize it. But if you annualize it and then discount it by like 2/3, just say figure in the long run, you'll keep 1/3 of the profits and annualize that, you're still doing freaking great. So this is actually, I mean, I'm not trying to, yeah, right, Larry. I'm not trying to give trade ideas here. Not at all, actually. But I mean, this is one that I'm going to take a closer look at after we're off this call here, and, take a look at it, because this is the kind of thing that makes sense. Yvette says, Larry says, but there's always a but, isn't there, Larry? There's always a but. Yvette says, how can I determine the volatility of a stock? How much is high or low volatility? Yvette, that is quite a question you ask. Oh, that's right, David. Oh my gosh, I'm crazy. NVIDIA's earnings are out tomorrow. This is a terrible trade. We would never want to make this trade. Yeah. I forgot. That's why I said I'm going to look at this more closely later. I totally forgot Nvidia's earnings are out tomorrow. So that's why they're so expensive. And Yvette, this leads nicely into my answer to your question. How can I determine the volatility of the stock? How much is high or low volatility? Well, there are a number of ways to do that. And the best way to do it is to look at a volatility chart. Now, there are many services online that you can subscribe to that have volatility charts. And if you find one that's not free, look for a different one. I think you'll find a free one out there. So the historical volatility is the volatility of the stock itself, but the implied volatility is the embedded volatility component in the option. And oh my gosh, I would say I could do a whole class on that, but I actually have done a whole class on that for Firstrade. So look at Firstrade's archive, which they keep on their YouTube channel, which is just, go to YouTube and search for Firstrade. There's only one T in Firstrade. Unlike Market Taker, where there's two T's, right? And look for, all my Firstrade webinars are all on the same PowerPoint template. So just, it'll be easy to scan your eyes and see the green on top, green on bottom. So you know which ones are mine. And look for the one on volatility. Where is what? Oh, okay. Got you, Larry. Okay. Yeah, Nvidia's earnings are out tomorrow. So, and that brings me to another point. If we are planning on if our objective is to skate on the trade, well, maybe this one was, I don't know. If the objective is to skate on the trade, we never want to do this going into earnings. There's just way too much risk. If our objective is to buy the stock and we don't care about earnings, then it could be okay. But, if you go too far out of the money, if you figure there's probably greater than a 50% chance of the stock going up on any given day, including and especially on earnings, you have less than a 50-50 chance of getting assigned, but you're selling such expensive option premium. What I have done sometimes, very rarely, but I have done this, is just to sell the at the money puts, like the 180 or the 182.5 before earnings. If I'm dying to get assigned and I'm willing to take the risk of a big gap lower, but if I sold the 180 puts and it gapped lower to 175 from here, $6 lower. $6 lower, that's only like 3%, right? Yeah, it's only 3%. Nvidia has gaps of actually, Nvidia's gap last quarter was 5.4%. Quarter before that, 2.8, then 2.3, 3.6, then 7.4, then 11.2. Its gaps have been smaller lately. Interesting. So 3%, well, 3% plus $1.60. It's got to fall $1.60 to be below the strike. So almost 4%, really. If I sold the 180 puts and got assigned, I'd buy it 4% lower. So, even if it gaps 10% lower, it's still better than just buying the stock today. But what's the trade-off? What's the problem with this? What if it gaps up 10%? Well, then I only made $5, which is about 5 point something, or wait a minute. My brain's 5.1 divided by 180. I'm only making about 3% on my money. Oh yeah, brain fart for a second there. I only make about 3%. So, you run the risk of leaving money on the table. So it's just really, it's a different way to think about your investing. It's not universe. Well, it is universe. I mean, there are white papers that show that selling cash secured puts is universally better than just buying stocks. Google white papers, or email me, dan@markettaker.com, and I'll send you some links to some white papers that say selling cash secured puts improves your Sharpe ratio, which is a measure of profitability divided by risk, basically, which is exactly what all investors want. It improves your Sharpe ratio. It yields better results than the buy and hold strategy while lowering your standard deviation. But every stock and every trade in every environment is not suitable for selling cash secured puts, in my opinion. Maybe white papers say they are, I don't know. But in my opinion, I think you pick your spots, and there's some situations where they're great to do and some where they're not as great to do. So now another thing or two here. Let's get this out the way here. For those of you who sell covered calls but have never sold a cash secured put, congratulations, you've sold a cash secured put. What? Dan, you're crazy. What are you talking about? Have you been drinking this morning? I have not been drinking this morning, I swear. I've been drinking coffee, and there's nothing in the coffee but coffee. Not even cream and sugar. Like it. Like it. Ugh. Strong black coffee. Just hits the brain, right? But a cash secured put is synthetically equivalent to a covered call because of, boom, David. Yes. Put call parity. Yes. If I sell a put, that is synthetically equivalent to buying stock and selling a call. That presumes it's the same strike price and the same expiration. And if that's the case, you're going to get about the same results, same risk reward. But you might say, but Dan, with a covered call, I own the stock already. If the stock goes down, I own the stock. But with the cash secured put, for all intents and purposes, you own the stock too, right? Because you are taking that cash to secure the purchase of your stock, and the broker's putting it aside, and you can't touch it. You're basically, in your mind, you should think, hey, I'm long the stock because you spent the money on the stock, and you have all the risk of owning the stock, and you have the benefits of owning the stock. Compared with the covered call. So they are synthetically identical. So cash secured put management, if the stock is trending lower, if my objective is to buy the stock, I will let assignment occur. If the stock moves violently lower, I might close the trade, take a small loss. I could use a stop loss, but this is if my objective is to skates and not get assigned. If assigned, if my plan was to get assigned, I'm thrilled, and I'm in the buy and hold strategy, and I'm probably going to sell calls against it. Or set a profit target for it. And that, friends, is everything I have to share today. Have any final questions before we go? And if anybody knows how to get rid of this stupid thing that pops up on my Mac, email me, please, dan@markettaker.com. All right. Have a great rest of your day, friends. Trade smart. Don't forget to check out my podcast, Wealth Building with Options. And I will see you next week. Ciao.